Hey guys, how's it going? It's Rohan here. Interest rates rising creates a positive impact on bank profits, making the sector one of the few to benefit from it. So in this video, I will go over how European bank will benefit from the high interest rate environment and specifically how Deutsche Bank stock performance will get a boost. And if we have not met before in this channel, you will find me every day with my analysis on crypto market and macroeconomic global issues. So do subscribe and let me help you keep yourself updated. So the European Central Bank, which was caught off guard by the sudden spike in prices, is taking drastic action against inflation by raising rates at an unprecedented rate. These decisions were motivated by the supply bottlenecks and soaring energy costs brought on by Russia's invasion of Ukraine during the COVID-19 pandemic. ECB's new projections released recently showed that inflation will remain above the 2% target until 2025, justifying Lagarde's promise to increase rates even more. The European Central Bank (ECB) policymakers have urged for an increase in interest rates to combat the double-digit inflation, and Christine Lagarde has echoed this sentiment, claiming that inflation might be even higher due to potential wage growth and government support measures being implemented in the 19 Eurozone countries. Swaps tied to policy meeting dates indicate that money markets are betting the deposit rate will reach a peak of 3.5% by July, which is a 60 basis point rise from the ECB's last decision on December 15th when it raised rates. At the 15th December meeting, the ECB surprised financial markets by matching the Fed's approach and vowing to dramatically raise interest rates in upcoming ECB meeting. As a result, they raised the main rate to 2.5%. Furthermore, they made clear that they anticipate further increasing these rates significantly. The 2.5% rate is the highest since 2008, a drastic change from negative interest rates in Europe lately. And this has a great positive effect on European banks as their deposit franchise now has real positive value. Before this, it was tough for them to even get close to breaking even with their cost of capital due to the negative interest rates that was prevailing. And because of those negative interest rates, they were undervalued according to the net tangible asset. Effectively, their operations had been destroying value. But then came this paradigm shift with the strong positive interest rates in Eurozone. Now let's see the effect of this interest rate situation on banks. Put simply, rate hikes will boost the entire banking sector. Rising rates are usually not favorable for companies in most industries as higher interest rates lead to higher cost of capital. But for banks, they make their money from the difference between what they pay to savers on deposits and what they charge borrowers for loans, which is what generate their net interest income. And since banks generally pass more rate hikes onto borrowers than savers, this results in a direct increase in profits. Additionally, banks earn interest on deposits kept with other financial organizations, including central banks. This is especially true for European banks. European banks have endured a decade of no revenue growth in spite of having a 3% yearly loan growth due to negative interest rates. During the second quarter of 2022, however, they experienced an 8% rise in earnings and net interest income spiked 14%. As progress seen in these earnings, analyst predictions for future profits are also on the upswing. Now, for US banks, US interest rates already rose earlier, thus diminishing the marginal gains of further increases and bringing banks closer to their peak earnings. Additionally, customers in the US are transferring deposits to higher yielding options, which increases pressure on deposit rates. Simultaneously, cost inflation is increasing and the Federal Reserve has halted quantitative easing. Despite this, the US banks were able to report a 4% revenue increase in the second quarter. Nonetheless, reduced income from fees somewhat offset the higher net interest income. The market volatility and uncertainty has caused a decrease in revenue from debt and equity issuances, IPOs, and mergers and acquisitions for those with sizable investment banking business. This taxing atmosphere will likely lead to layoffs in the US banks. Moreover, the European market's volatility has increased the likelihood of capital increases in some individual stocks. Now, the interest rate hikes scenario in general will be most advantageous for traditional retail banks with sizable deposit bases, but the entire banking sector is expected to see increased profitability due to improved net interest margin. Analysts suggest that when interest rates reach a positive territory, European banks' return on equity could climb from mid-single digit to a low double-digit level of around 11 to 12%. And the data from S&P Global Market Intelligence revealed that the 15 biggest European banks, as measured by market capitalization, saw an average return on equity of 8.6% in Q1 2022. And banks are gaining from this increase since their assets on the balance sheet, consisting of loans with variable rates of interest as well as security portfolios, can be repriced more quickly and to a greater extent than deposits on the liability side. And as rates go up, the gross yield on these assets also grows. Some reprice almost immediately, while others have a lagged effect. For example, when securities mature and are reinvested in higher yielding instruments. Now, talking about Deutsche Bank, the benefit for Deutsche Bank due to the increasing interest rates is hard to measure accurately, given there are multiple variables such as deposit betas, which is a level of deposit shifting from low yielding to higher yielding ones. So deposit beta is the metric that shows how management alters the rate paid on deposit accounts by customers in relation to changes in the market interest rates. As an example, if the market interest rate rises from 1% to 2% and management increases the rate they give on the deposit accounts from 0.5% to 0.9%, then the beta would be 40%. And how is that exactly is that? That's because the market change was 1%, but the increase in the deposit rate was 0.4%, that is from 0.5% to 0.9%, and hence the deposit beta is 0.4 divided by 1, which gives me 40%. And so this is different for different banks because it is a decision of the management that how much they will increase the interest rates on the deposits that they will pay. So some deposits may not reprice at all, such as operational deposits, and thus would have no increased interest cost. The rest of the liabilities, however, may reprice more slowly than assets. So now coming back to the point of how Deutsche Bank will be positively affected by this rising interest rate scenario in the Europe. So again, it is hard to measure the exact advantages Deutsche Bank will get due to the multiple variables such as deposit betas and all that we just discussed. But Deutsche Bank itself gave a guidance on how these increasing rates will affect their business in the recently concluded UBS European conference a few weeks back. And the guidance was like this. So they said the guidance we gave a couple of weeks ago was that relative to 2022, interest rates alone should support revenue by about 2 billion euros. And then that would be offset by something in the high single digit 100 millions of euros by the year-on-year impact of no targeted long-term refinancing operations or TLTRO, higher funding cost, and some of the benefits we had this year, for example, debt repurchases and so on. So the net of those things should give us something between say 1.1 to 1.2 billion euros of revenues next year relative to this year. Now, this is a major consideration for Deutsche's investment thesis, as Deutsche's total market capitalization is euro 20 billion. It's undeniable that this will be great catalyst for the stock, that is a rising interest rate scenario. Yet the market has been quite unresponsive till now to these huge advantages. But the Deutsche is restructuring quite successfully. At the UBS conference, it was confirmed that Deutsche is on track to reach its 8% ROTCE goal, that is return on tangible common equity, by financial year 2022. In fact, the core bank is already delivering 10%, not including any gains from rates. This probably will be reconfirmed when Deutsche reports full year 2022 result in first quarter 2023. And also it's worth noting that Deutsche is managing to achieve these outcomes sustainably. It is not a one-year hack or something. And Deutsche's corporate banking and German private banking have seen significant growth. This lessens their reliance on the investment bank. Additionally, DB is gaining back market share from US competitors in FICC business, that is fixed income, currency and commodities business. Despite investing heavily in compliance and other regulations, it is managing its cost well. In conclusion, it looks like Deutsche will meet its goal of 10% ROTCE, that is return on tangible common equity, by 2025 or before 2025. Now, Deutsche, as part of its reorganization, has shifted its focus to FICC trading and completely stopped equities trading. This decision has been proved to be beneficial. In addition, it was able to dodge numerous issues that competitors such as Credit Suisse encountered in the Archegos capital management incident. Furthermore, Deutsche is taking advantage of the long-term expansion of FICC wallets in recent years. So Deutsche has been able to regain market share in the FICC during 2021 and 2022 due to US bank pulling back due to capital constraints and some counterparties wanting to diversify their trading with European houses. This is beneficial for Deutsche Bank franchise as it currently has higher interest rates. Evidence of this can be seen in the Q4 update from US banks at Goldman Sachs Financial Service Conference, which point towards a positive outlook. So Citigroup and JP Morgan have both reported an increase in FICC of over 10% annually. So I anticipate Deutsche Bank to follow suit with impressive result for Q4 that will meet their 8% return on tangible common equity target. Furthermore, the company, that is Deutsche, may opt to book a mini kitchen sink quarter, which would set them up nicely for 2023 and onward. This could be done by taking on additional restructuring charges. Beyond that, Deutsche has made clear that its dedication to returning capital to shareholders via dividends and buybacks. This was further emphasized at the UBS European Conference update. So what they said is that, as we talked about in March, we have started on this path of capital return, which of course we had to make the painful decision to suspend the dividend for 2 years. We restarted the dividend this year at 20 cents, and then in March we gave investors a very clear path of 50% increase in the dividend every year for the next several years to 30 cents next year, 45 cents, and then 68 cents. So at present, the largest concern is a potential global economic downturn and consequential higher credit losses. Nevertheless, I don't consider this to be a major risk factor due to Deutsche Bank's low risk credit profile. Its primary investments are German mortgages with a healthy loan to value average ratio. It is also markedly different from its US and UK counterparts in that it has virtually no exposure in unsecured consumer credit. This implies that the 6 to 7% dividend yield should be achievable by 2025 based on the current share price, inclusive of extra capital distribution via stock buybacks. Despite the current recession, I do not anticipate credit losses to have a significant effect on Deutsche's overall profitability. In other words, the increased interest rate should more than make up for any potential credit losses. So Deutsche currently trading at an undervalued of 0.35x of tangible book value, and I'm confident that Deutsche can achieve a sustainable ROTCE of 10% or greater by 2025 and possibly even earlier, probably in 2023. The macroeconomic environment bodes well for Deutsche's success in fixed income, currency and commodities trading, and volatility in rates has been advantageous for the trading business given the end of financial repression from central banks over the past decade. I anticipate a successful Q4 and possibly an outstanding Q1 of 2023 as investors adjust their portfolios in preparation for an upcoming recession. In 2023 and beyond, FICC trading income may subside to some extent but will still remain at a higher rate compared to pre-pandemic condition. Nevertheless, the most beneficial effect of increasing euro rates is that Deutsche Bank's deposits are now more valuable than they were before. Now, many top economists do believe the end of the negative interest rates is likely permanent, which will allow European banks to make return more on par with the US counterparts. Investors seem not to have realized the potential benefits that come with the rate increase, and this could add almost euro 1.2 billion in pre-tax earnings for 2022 and additional profits in later years. And Deutsche Bank's sound financial situation and ability to produce excess capital indicate that meaningful growth in dividends and share buybacks will probably occur within the next 2 to 3 years. So coming back to the overall situation in the banking industry, the overall banking sector stands to benefit from higher interest rates, though the current economic downturn creates a risk of deteriorating asset quality and increased loan losses. Despite cyclical and geopolitical uncertainty, European banks still offer an attractive risk-to-return trade-off. And the European Banking Authority's most recent data shows that the weighted average non-performing loan ratio, that is amount of bad loans to all outstanding loans, decreased from 6.5% in Q4 2014 to 1.9% in Q1 2022. Further, UBS analyst report in July 2022 states that while the economic slowdown could increase credit cost for European banks, the sector has substantial loan loss provisions built up over the last 2 years. This is due to the fact that most of them have performed better than anticipated during the 2020 pandemic, allowing them to absorb nearly 3 times the loan losses recorded in the pandemic year 2020 before running out of capital as compared to their management targets. However, overall, in conclusion, I do need to note that over the past decade, stock investing in banks, particularly European ones, has been unrewarding, with returns lagging behind those of the Euro Stoxx 50. American banks have seen more favorable results, but even there, bank stocks are overshadowed by tech stocks' meteoric growth in recent years. When compared to the S&P 500, 2021 was kind of an exception to the general trend. But I believe 2023 will be much better for the banking sector. That pretty much wraps up this video. If you liked it, do smash the like button, and also don't forget to subscribe. See you in the next one.